Well, if you've got rising revenue while the value goes down and then back up and you're not forced to refinance or sell, you're in a really good situation on the other side when values go up again. That's why I like a long-term hold.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
My name is Sean Graham, and I'm one of 6 hosts who bring you conversations 3 times a week on a variety of topics, including real estate, business, and personal motivation. Our goal with this podcast is to help you succeed in whatever target you're aiming at. We're all committed to finding the best and the brightest people who aren't just talking about doing big things, but they're actually taking the steps to achieve their dreams. And we want to help you along the way. So today is no different. I am joined by the one and only Paul Moore. Paul is the founder of Wellings Capital, which has over $120 million in equity under management. And he's been investing in real estate since 1999, including self-storage, multifamily, RV parks, and more. He also wrote the book Storing Up Profits, which was published in 2021 by Bigger Pockets. So without further ado, let's get started. Paul, it's a pleasure to have you here.
Sean, it's great to be here. Thanks, man. It's a real honor.
Yeah. So I was just, going through your bio and everything before, and I read your book, and the book is awesome. First of all, the Storing Up Profits. Yeah, it's really a good book. And I listened to it on Audible, but there's just so much valuable information there. And, I guess you have a long background going from working at Ford Motor Company to starting your own staffing company. And then you ended up in commercial real estate, and you've invested in a lot of different asset classes in commercial. But could you just kind of give us a little bit about your background and give us the overview?
Yeah. So I had an engineering degree, which was my first mistake. And then I went on to get an MBA at Ohio State, went to Ford Motor Company 5 years, and then joined a business partner to start a staffing firm in Troy, Michigan. And we were really fortunate on the timing there. About 4 or 5 years into it, Wall Street kind of went nuts after the type of staffing firm that we were, which is a PEO, professional employer organization. I can circle back to that if you want, but we ended up selling to a publicly traded firm, and I found myself without a job and thought I was semi-retiring, which was a second big mistake. And I also thought I'm a full-time investor now. And the truth was that was my third mistake, because I thought I was an investor, but I found out later that when I lost a lot of money here and there and everywhere, it seemed, I thought, I wasn't a full-time investor. I was a full-time speculator, and I didn't know the difference. So thankfully, after years of hard knocks, I made a lot of money doing that, but I also lost a lot of money. And after reading Warren Buffett and learning a lot about the truth about investing versus speculating, I figured out the difference and started investing in real estate in 99. My first commercial real estate deal in 99. Then did residential for 11 years. And then jumped back into commercial with both feet in 2011. And I've been doing that ever since.
That's awesome. That's very cool. So I have so many questions for you. I mentioned to you before the podcast, but I actually started out, accounting was my background, and I went the CPA route and everything. And that was good. It wasn't that it was a mistake. I learned a ton, and I wanted to learn how to run your own business, and I was able to do that. But I was always drawn more towards the entrepreneurial pathway. And it sounds like you were in a similar position where you got this engineering degree, and then you were working for Ford. So what did that transition look like for you? Like, how'd you end up leaving? Were you kind of building your own business on the side, or what happened?
Yeah, a month or two after I started working at Ford, the same guy I eventually partnered with, he and I would compare stories after hours. I loved Ford. He hated Ford. But we started toying around with starting a business on the side, and we made two or three failed, not so much failed, but attempts at things that just didn't get off the ground in Michigan. And then he eventually quit Ford, went to, I think it was Trammell Crow or one of those big firms, and he eventually left there and started a staffing company, and I joined him. A couple years later. So yeah, I was working on the side evenings and weekends for 11 months. Seemed like most waking hours. And I got to be honest, Sean, what did people do before the internet? I don't even know how. I remember going to the library for hours and hours and hours, reading up and studying every article and thing I could written on this. But I mean, it wasn't that well known. So whatever. But anyway, PEO, the Professional Employee Organization, is a company that offloads the human resource liabilities and administrative headaches for small companies. So what we would do is we would effectively hire every employee at a small company, a company from 5 to, let's say, 100 employees. We would put them on our payroll, lease them back to the company, and that would include the CEO, and that would include the janitor, everybody in between. And we took over, payroll, benefits, workers' comp, unemployment insurance. We provided the employees a upgraded benefit package. The employees could now access a 401k and all kinds of health benefits, life, dental, vision, all kinds of things that a 5-person company couldn't dream of having. And we did their payroll and all that stuff as well. So they just cut us one check or wire every week, and we did everything else. And it took that hassle out of the employers, out of their life, so they could focus on being a great, entrepreneur.
Wow, that's so cool. So you built that up over the course of what, like 5 years or so, and then you ended up selling to a publicly traded company. Is that right?
Right. Uh-huh.
Wow, that's amazing. I just recently, I mentioned this to you as well. Recently started like a virtual assistant staffing company. So the idea is, hey, we go in, we help entrepreneurs lower their overhead or offload that 80% of the work they shouldn't be focused on, so that they can focus on that 20%, do it at incredible value, find them the right people, and then we have guarantees in there and ideas to help small businesses and entrepreneurs become more profitable. So it's a lot different actually, right? Because we're not handling the overhead.
No, it's really similar function.
Right. So, and I think a lot of, hiring is just a headache in general. It's just a headache for people, and people don't have time to go ahead and dig through and interview hundreds of people and find the right person. So just kind of curious, like, did you ever think about going back in that space afterwards?
Well, we did actually. Toward the end of that wonderful 5-year run, we got a couple ideas. One, to do a nurse staffing program, a nurse staffing company, and we did that. And then another one was a therapist staffing company, which is, similar, and we did that. And honestly, neither one of those ever did that well. I mean, I think we probably made a profit on both, but it was minimal. We ended up closing both companies after a number of years of scratching along. It was much, it just reminds me, I mean, my biggest mistake, I mentioned 3 mistakes already, but my biggest mistake ever, by far, done multiple times, Sean, is trying to do more than one thing well at one time. I finally, after years of this, after years of headaches and heartaches and losses and stress, I read a book called The One Thing. You've probably heard of it, by Gary Keller and Jay Papasan. And that book convinced me I have got to focus on one thing at a time. And so that's sort of my mantra now, is to just focus really well on one thing. In fact, I still have a second company in addition to Wellings Capital that I've been hanging on to for 19 years. It's running in the background. Even though I work an hour or two a month on it, it's still a headache and a distraction. And actually, I'm working this week on selling that company finally. So,
Wow. That's pretty big. That sounds like it might be your baby after 19 years.
it's
That's a
not.
long time.
Yeah,
No,
you would
you're
think. No, it was for years, but it's in the residential real estate space. And once I got into commercial, I liked it so much better starting in 2011 that it's honestly been on the back burner ever since then.
Yep, yep, that makes sense. Yeah, a lot of it is just it's not that you're not capable of doing more than one thing. It's just that it takes up the brain power. Like you only have so much capacity to really excel at one thing, and that's the whole that's the Keller's message, right, in the book. And I struggle with that too because as an entrepreneur, a lot of times you have shiny object syndrome, and you kind of want to get into a little bit of everything. But yeah, I guess so. You switched over into commercial real estate at some point, and it sounds like you've been in multiple asset classes within your fund. Can you tell us more about Wellings Capital and the types of investments that you guys go into?
Yeah. So after success in 2011 to 14 or so with a multifamily quasi hotel project, ground up project with the same business partner in North Dakota during the oil boom, and then another. We did two of those, and they turned out really well. They were next door to each other, and anyway, I spun off and did a multifamily. I started a multifamily syndication firm, and that was Wellings Capital. It's what became Wellings Capital, I should say. And in that firm, our goal was to buy, value add apartments, 1980s or 90s vintage, do a lot of value add, and then optimize the income, either refinance or sell them for a profit, kind of the typical syndicator formula. I actually wrote a book with a humble title called The Perfect Investment in 2016 about multifamily. But by 2018, I was on podcasts and all over Bigger Pockets and anywhere else who would listen, warning them against multifamily because I said, hey, the perfect investment is not perfect if you have to overpay to get there. And so it was about that time that we diversified out into first self-storage, then mobile home parks. We saw that investors had a real need for intense due diligence on operators, and they weren't doing it on their own. And I understand why. I mean, they have lives. A lot of them are doctors, lawyers, IT people, and they don't know how to do due diligence. They don't know how to find that one error in a spreadsheet that causes all the returns to be much different than they really should be, and all the other stuff that goes into due diligence. So we set up Wellings Capital version 2, if you will, as a fund that provides due diligence and diversification to investors. Our goal was to diversify across multiple asset types, geographies, operators, strategies, and of course, properties. And so we are now on our 6th fund, and we're having the time of our lives.
That's awesome. That's amazing. So you mentioned overpaying, right? And people started, like, apartments became overpriced. Multifamily did. Are you seeing the same thing at all in self-storage now? Like with the changes in the economy, do you, I guess, what are your thoughts on just where the market stands with self-storage?
There's so much I could say about this topic. To summarize it, I think multifamily had a onslaught of guru trainers, people who would teach people, people with a regular job, like this guy. I'm trying to remember his name, the name of his company. It's not important now, but he was trained. He was a mid-level IT guy, about 58 years old. He went through one of those training programs and somehow amassed billions of, wait, I'm mixing up two stories. They're super similar. I'm trying to be honest here. So he amassed a whole lot of multifamily in a very, very short time. Now, these other two guys, and this has been on the headlines of a lot of places, Tides Equities, they were only like 28, 29 years old. They did the same thing, and they did amass $6.5 billion in multifamily. These stories are real similar. But, these guys were both trained by gurus, people who, would teach them or train them. I don't know all the details of all their stories, but we've got multifamily intensely high popularity. You got social media touting it like crazy. You've got retail accredited and non-accredited investors rushing into it. You've got all this hype, like people writing books called The Perfect Investment, stuff like that. Seriously, all this hype about how great multifamily is, how people always need a place to live, and how it's always going to go up. And there truly is a supply and demand disconnect to this day in multifamily. There's a shortfall of housing in the United States. Well, the problem is there were literally tens of thousands, I'm not exaggerating, of people trained by some of these gurus. And some of them are legit mentors. Like I had a mentor myself, and he was a legit mentor. I would not call him a guru, but there's others that whatever. So these guys are all competing against each other, overpaying, outbidding each other. Somebody would bid 10% more than it's worth and think that they're going to get it, and they'd fix it, make it up later in rents and improvements. But then somebody else would pay 20% more than it's worth. And 2 years later, somebody else would pay them 20% more than that. And this continued. And that's when I started studying Warren Buffett and realized that he has seen this over and over and over in his 67 years or whatever at investing. He's seen this over and over. He's warned about it over and over. Howard Marks, who wrote a wonderful book called Mastering the Market Cycle, he warns about it all the time. And I said, well, this is happening here too. So multifamily, part of the problem was a lot of these folks, in order to make the deals pencil, they got floating rate debt. And when they got floating rate debt, they were also, again, they were overpaying. They wouldn't admit that usually. They got floating rate debt. They were giving really aggressive assumptions, like saying stuff like, hey, rents have gone up 15% a year in Tucson, but we're only underwriting to 10% a year in the future. Well, that's probably not the best plan, and it's probably not sustainable. And of course, with a floating rate debt now, let's say doubling in cost, rents not going up, in fact, going down in some locations, and a lot of other problems. Inflation on the costs still rising even when rents aren't. The difficulty of getting great employees in maintenance and property management, all the stuff's crashing down on these folks right now. But then, Sean, something happened I never predicted. And I wrote a lot of articles about this in Bigger Pockets, to the point where I irritated some people, as you can imagine. But one thing I didn't ever think of or know was the reserve requirements by banks. Some of these banks, they have these lenders have built-in reserve requirements. And so if you have floating rate debt, let's say you got in at 3% floating rate debt. Well, good for you. But now it's up to, let's say, 7%. But you've got a cap. You bought a cap at 5.5. Well, going from 3 to 5.5 is still horrendous increase in costs and taking a lot of these deals underwater. But on top of that, the lender can say, hey, that cap is expiring. That rate cap's expiring in a year. And so I have numerous stories, including friends of mine. I was on a mastermind with several friends. We do it every month. One of them said, yeah, I was paying $2,000 a month for my interest rate cap into reserves, and the lender just increased it from $2,000 to $70,000. And another guy goes, well, that's bad, but mine went up from $1,000 to $89,000 per month. Sean, how is that sustainable in addition to all the other problems they're dealing with? And so all that long-winded answer is to say that happened a lot in multifamily through some of the factors I mentioned and more, but not so much in self-storage. Is it possible on a one-off basis in self-storage? Absolutely. Is it going to happen? Yeah, especially ground-up development deals. But self-storage has a client retention power. Once a facility is fully occupied, I would consider that at 90% to 95%, for example. Once it's fully occupied, it's got staying and occupancy power that multifamily could only dream of. And so, honestly, I mean, think about it. Self-storage. Let's say I have a $2,000 a month apartment in Grosse Pointe, Michigan, and the landlord raises it by 10%. Well, I might leave rather than pay an extra $200 a month. But if I have a $100 a month self-storage unit and the landlord goes up by 10%, I'm probably not going to spend a weekend, get my friends together, or rent a U-Haul to take my stuff down the street just to save $10 a month. And that's one of the powers of self-storage.
Hey guys, just want to take a minute and let you know about Maven Equities. Maven Equities is my private equity company, and what we do is we invest in self-storage. So we have existing self-storage facilities, value-add opportunities, we have expansion opportunities, and we have ground-up developments. If you're interested in possibly investing, go to our website, mavenequities.com, or you can go ahead and email me, Sean, S-E-A-N, at mavenequities.com to gather more information, and I hope to connect with you soon. So, Paul, this is very interesting what you're saying about where apartments were before and still are to some extent. So with self-storage, right, do you see issues arising for those, a lot of people got fixed, you get commercial loans and you get fixed debt for 5 years or so, but then it often resets. It's typically not fixed for the full 25 or 30 years. What are your thoughts there? Because we're in a completely different market, and obviously sellers, they still want the same cap rates that they did a year ago, 2 years ago, right? But it's just not the same market as it was before. And so in a way, to me, it looked like a lot of self-storage started to become overpriced, and people were paying a little bit too much for it, right? Or could just because interest rates were so low. Do you think, I guess just like in the near future, do you think having those 5-year resets on debt is going to come back and disrupt the industry at all?
Well, I mean, we're a 10-year fund, and honestly, we may in the future go to a evergreen because we don't like the pressure to sell. We don't like the pressure to refinance. And we think that's the cause of a lot of problems. I mean, debt itself, is a potential, I say potential, cause for a lot of problems. But at any rate, having a 10-year fund, which is what we do, that gives our operators some breathing room, assuming they're getting, and they're not always doing this, but if they were getting 7, 10, 12-year debt, that's obviously giving them breathing room. What can happen is you've got, the values going down while cap rates expand, of course, during interest rate hikes like now, but then going back up later. Well, during this whole time, not always, but sometimes, often, rates, rental, and therefore revenue is still maintaining pretty well and continuing to rise. Well, if you've got rising revenue while the value goes down and then back up, and you're not forced to refinance or sell, you're in a really good situation on the other side when cap rates, compress again and values go up again. And so that's why I like a long-term hold. However, there are self-storage operators getting shorter term, floating rate debt. And I think that they're going to face a lot of the same horrors that a lot of multifamily people are facing right now as we speak.
Right. All right. That makes sense. Now, with storage in particular, do you are you in favor of more existing facilities, value add opportunities, or the conversions or the ground up developments? I mean, you talk about a lot of it, all three of them in your book, and your book is fantastic. by the way. But I'm wondering, what you like to focus on right now with self-storage, and also just how your book, anything that's changed, like the market, it's a
Yeah.
completely different market than it was.
Yeah.
I don't know when it was released, a year ago,
2021.
okay, 2 years ago. But just kind of the changes that you've seen, or any differences that might be from when you wrote it to now.
Yeah. So like I mentioned earlier, Sean, the biggest risk in self-storage is the lease up period. And the two most difficult deals we've ever invested in our fund have been ground up development. One was actually developed, it was already fully built, but it was just leasing up still. So I'll put that in the same category. So the older I get, the more risk averse I get, and the more I'm happy with singles and doubles rather than trying to hit grand slams. And so with that in mind, yeah, I like, value add self-storage facilities that are already doing okay, or they're in great locations, but they're poorly run, but they've got great potential. Like one we invested in just outside of Las Vegas a few months ago. It was 30,000 square feet. I believe it was $3 or $3.2 million. It had homeless people living in some of the units. A whole lot of the units were vacant. The place was a mess, didn't have a website, didn't have marketing as far as I know. And the rates were like a 10 by 10, the rate was $60 a month, when the going rate in the market was about $150 a month for a 10 by 10. And that's when the people paid. And so taking that over, it was a little riskier than just buying a stabilized asset. But, acquiring that for cash, going in, fixing it up, getting the marketing working, getting everything going in the right direction, and then refinancing it later with debt, with fixed rate, low LTV debt, is a golden opportunity. So that's the answer to that question. What was your second question, Sean?
Well, the two questions were really like, what do you favor right now, and the existing and versus ground up, and you kind of answered them right. And what's changed? The book was so good, but so much has also changed in the past.
Yeah. So I made a big mistake in my book, and I actually would love to rewrite. I would like to add a chapter to it. I haven't asked BiggerPockets about it yet, but I completely underestimated the role of automation. I talked about automation. I talked about, some of the value adds of self-storage being, you can have a person there to upsell units, to greet customers warmly, to sell locks, boxes, tape, scissors, all value add upgrades, to lease U-Hauls. All those are great upgrades. But I think I discounted the role of automation. I think I kind of played it down like, automation's not that great, you'll never be able to replace a person. And that's still true. You can't fully replace a person, but what matters in the end to investors is the economics in total. And while I might be missing all those value adds, I might also be missing $100,000 in expenses that could really make the deal better by being automated. So I think I made a mistake in the book by downplaying that. I spent 2 pages to my memory in the book on automated facilities. I gave an example of one, but I think that if I had to do over again, I would do a chapter on automation, when it makes sense, when it doesn't, and where it's going. Now you got to remember, several years before COVID, when I was in the process of starting the book, people had to pay, I believe it was $32,000 to get a kiosk installed that would eventually be outdated, to be able to use automation, that allowed somebody to come up and, to the kiosk and type in their stuff and go into the facility. Of course, that now, COVID accelerated the technology that was already much, much better than I knew about. And now people can do that with an iPhone. They can just, lease a unit. They can get into the gate. They can go in with their iPhone and do stuff that, they don't need a kiosk. And there's other workarounds in automation. So I guess I would ask you, what do you think? What do you think of automation?
Yeah, it's funny. So in the book, you did talk a lot about staffing. You're saying like you actually prefer to have somebody there, like on site who's working. And it all just comes down to economies of scale, right? Because if you have a 20,000 square foot facility, you're not going to be able to afford a full-time person. It just won't make sense. But if you have a 100,000 square foot Class A facility and it's bringing in, you know, $2 a square foot a month in rent, then yes, like it makes sense to have somebody there for the upsells. But it all comes down to how much revenue you're bringing in. I don't know. I don't know what that break even point is. I think automations, like to some degree, it's been oversold a little bit, to be honest, because there are still a lot of customers who they're old school. They like, and I'm realizing this more as times are a bit tougher. Like a facility I have is in a more blue collar area, right? And so occupancy has decreased a bit, and there's a lot of older people who they want to pay with like cash or check, right? They don't even want to go through and pay ACH or card. And before you kind of had the luxury of saying like, well, no, it's card or nothing, go somewhere else. But at a certain point, you start thinking, well, okay, like, is that going to be the difference that gets me over the edge and gets me to, back up over 90% occupied because I'm the only one who will do the work and take the check. And so an ideal world, yes, everything's automated and it's a very passive business. But there's probably some opportunity by doing the dirty work as opposed to just automating things where you might have an edge on somebody else. And if you're struggling, yeah, it might be the time to do it.
Yeah, I agree.
It's tough. It's hard. But there's no exact right answer for anything. It's really a case by case basis and a facility by facility basis, and who are your customers and what are your goals. But now you're not just in self storage either. So you came out with an RV report recently. I think it was in January, and that's something that I don't know much about, and I would love to learn more about it. If you kind of want to dig in, it's the RV Park Special Report, I believe is what it was called.
Right. Well, our funds, again, we're trying to give people diversification across various asset types, geographies, etc. And we wanted to do RV parks for years, Sean, but we didn't find an operator. Like I said, we're intensely focused on due diligence, finding the best operator to manage a property that has a great team, great history, a lot of their own money in the game. And we finally found an operator we really liked and we connected with. My wife and I went down, I think, a year and a half ago to stay in one of the RV parks. My business partner flew down to their headquarters and then sent another person on the team. So 3 of us have been out to do due diligence at one of their RV parks. RV ownership has gone up 62% in a couple decades since 2000 or so. But while 11 million people own an RV in the US, about 9 million more say they want to buy one. And so there is a real trend in this direction, but COVID just accelerated the trend incredibly. I mean, 26% of RV campers were first-time campers in the year 2020. And remember, that was a year when people were scared to leave their house. They were staying at home. They were canceling all their vacations. But 26% growth, or 26% of the campers were first time, I should say, that year. The rate of new 2020 RV campers grew by 5 times the record year, which was just about 5% in 2019. So we've seen a really, really historical shift RV sales, like I said, that 9 million people reportedly want to buy an RV, but there's only about 600,000 or 700,000 a year that could even be produced under the current situation in the U.S. And so it leaves you wondering, well, what's going to happen here? You know, I mean, all these people they're not going to be able to buy RVs. Well, we've got this thing, this first in world history, and I can confidently say that. I don't know how anybody could disagree with this. We've got this remote work revolution. And, you know, COVID has caused so many people who were convinced they could not work remotely or could not work from home. Of course, we know now that they can. A lot of people can. A McKinsey report says that 35% of employees can work full-time remotely, and 23% have been offered remote work on a part-time or occasional basis.
Hey guys, just want to let you know about another company that I have. It's called Maven Success. MavenSuccess.com is the website. We are a virtual assistant staffing company. So what we do is we go out and we find the top tier talent, the top virtual assistants for whatever field that you need help with, and help you offload the work that's taken up too much of your time, that you want to get off your plate so that you can focus on the things that are really the most valuable. You'd be shocked at how good the talent is in many other countries, and the rates are phenomenal as well, right? Because the cost of living is not the same here in the US as it is overseas in other countries. People are looking for work, they're happy to have great opportunities, and for you, being a busy entrepreneur, you might not have the time to go out and find the top tier talent, or you might not want to go out to the marketplace, right? Where things might be a little bit overpriced and you really don't know what you're getting. Let us do the work for you. Finding the best talent, just go to mavensuccess.com or email us at info@mavensuccess.com. Let us know what you might be looking for, or just sign up for a free consultation and we'll help you identify those things that we can get off your plate, again, to make you more valuable by freeing up your time to do what you do best.
So this is a huge, huge shift. And what it's meant also is there are people who have realigned their priorities. I mean, they thought they might die. They heard about a relative or friend or coworker who died, and they're like, you know what? I don't know, why am I slaving away in Manhattan or Chicago or Detroit when I could actually be, you know, doing the same work, you know, at a place I really like Silver Lake, Michigan, or Mackinac Island, or Smith Mountain Lake, Virginia, or Tahoe. I talked to a guy today who moved to Tahoe during COVID, and now he's working from there and he's doing fine. And so, but you've got this whole other group of people who want to hit the road. In fact, a CEO of a real estate tech company, a startup company, actually hit the road. He rented his house in Roanoke, Virginia. He bought a nice RV and he hit the road, and he has been on the road full time for I don't know how long now, but he did that during COVID. And so all this is putting a huge demand on RV parks. But what's putting even more demand in some ways on these parks, or I should say what's accelerated this even more, is the sharing model. Now, of course, we all know that Uber has displaced a lot of taxi drivers, and we know Airbnb, you know, has grown from a startup just a short time ago to having 5 times as many rooms as the largest hotel chain in the world, almost 100-year-old Marriott hotel chain. And so this sharing economy has hit the RV world as well. So we've got RVshare.com, we've got Outdoorsy, and people can, you know, now that instead of having an RV that sits in their yard or at a storage unit for 49 and a half weeks out of 52 weeks a year, now they can rent these out, and they've got a rolling rental unit. They've got a small business. I know somebody who bought an RV about a year and a half ago in Colorado. She put it on one of those rental programs I just mentioned, and she paid $80,000 for the RV. Well, she netted $40,000 profit the first 6 months. I don't know how she's doing now, but I'm assuming she's continuing to make profit. But this is a huge opportunity. But think about this. The pressure that all this is putting on RV parks, which have a limited supply, is enormous. I mean, I got a neighbor on each side, 2 doors down one way and 5 the other way, who have RVs. The one over here, he's got one of those really high dollar Winnebagos. He said he had to wait a year or two to get it custom ordered. And he said now he has to rent his spots in RV parks, the nice RV parks, a year in advance. What? Who ever heard of spontaneity a year in advance? But that's what he's going through. So I think that this trend will be recession resistant. I don't think it's recession proof, not at all. But I think it's recession resistant, and I think that Sam Zell had it right. I mean, Sam Zell started buying mobile home parks when they were definitely not cool in the 1960s, and he built up 158,000 mobile home park pad portfolio, and also RV parks, decades ago. And so most successful real estate investor in America, possibly the world, made some right moves. And so we're trying to follow in both of those, and they're in his footsteps in both.
Yeah, I like that. You follow two icons with Warren Buffett and value investing, and Sam Zell there. Those are two great examples to track. But so with the RV parks, can you tell us more about those? So, and what is Wellings Capital doing with the RV parks? Are you guys building more? Like, I believe with mobile home parks, right? People don't really build mobile home parks anymore. The supply that's there exists, but RV parks, that's different, and they're more of like a Airbnb model where people are just coming in and they're renting a space for the weekend, right?
So there are 4 types of RV parks that I know of. Number 1 is an overnight park, and these are designed for travelers on the move. They're stopping someplace. They're heavy on convenience, light on amenities. Second type is the opposite extreme. That's extended stay. I was at Smith Mountain Lake this weekend, and on Saturday I noticed that the RV park where I had lunch next to, a bunch of the RVs had decks built around them and steps and all kinds of permanent stuff, because those were extended stay. They were there for not only the season, but for the year and for years. My friend owns an RV park at that same lake. And he said that he's got, I think he said, a 7-year waiting list to get in the RV park. Amazing. And he charges people a year in advance, like for the whole year. And so not a bad business model. A third obscure type is a workforce housing RV model, and that would be a camp, like let's say near a big oil pipeline or oil refinery or construction project where they have an RV park where construction workers can stay. And we saw thousands of these, not parks, but individual RVs, I should say, staying in parks near us in North Dakota, right down the street from us. And then fourth, my favorite, is a destination RV park. Now that really is 2 different kinds of parks. There's the kind that's close to a destination, let's say near Gatlinburg, Tennessee, or near Mackinac Island, Michigan, or maybe a national park like Yosemite. That's a destination RV park. There's another type, and that is where the RV park is the destination. And I think these are especially recession resistant because an RV park like this, which is what we're investing in, and we're not building, by the way, to answer your question, we're investing in these destination parks. They have all kinds of value adds. So they might have for example, I'm thinking of real numbers here, $500,000 invested in a 5-acre lake. And then they might have a fishing pond next to that. And they might have whibbits on the lake. It's a fun obstacle course, like sort of a foam-looking obstacle course that floats on the lake. And you can rent those out to kids or adults for $16 or $17 per person per hour. Well, that adds up to $1,000 an hour in the summer months. It's a pretty good deal. They've also got face painting, horseback riding, golf cart rental. Sometimes the golf carts rent for more than the RV space. They have glamping units. They have cabins. They have dog parks. They have, sites that have, dog pens that they can upcharge $50 a night for or more. They've got $2.5 million. This is a real example again. $2.5 million water park added. They've got, all kinds of things. Gold, those little gold mining things. They have drive-in theaters, putt-putt golf. Some of these are just built-in amenities. Some are upcharge amenities. They have food, wedding venues, all these things. And so there's so much to love about these. Now, the downside is that, you might get a $2 or $3 million park like we invested in a couple of, but have a $18 or $20 million total budget to get it fully built out. Well, that's a big lift. But the good news is you're creating incredible barriers to entry around that park. Who's going to compete with that guy,
Wow, that is fascinating. Yeah, it sounds more in line with just like running a small business than it is the real estate or like passive real estate, right? It sounds like a very hands-on, active business, and so I'm sure having
very hands-on,
right? Having the right managers is probably the biggest piece of being successful. So in self-storage, right, like a lot of the attraction was that, okay, out of the whole pie, 80% or 75% maybe it is now are owned by mom and pop investors. And only 15, 20%, maybe 25 now are owned by the big institutional players. Do you think institutional players will start moving in that direction and going into RV parks? Because I'm just making an assumption that right now it's all 100% mom and pop, but maybe I'm completely wrong on that.
Yeah, so I don't have the exact stats on this. I should, but there are 2, possibly 3 big players in the RV park world. That would be Equity Residential, owned by the late Sam Zell. There's also Sun Communities, and I believe I heard there was a third, but I've never pinned that down. Then the vast majority of other parks are owned by mom and pop operators. And these mom and pops, just like in self-storage and mobile home parks, they don't have the knowledge, the desire, or the resources to increase, to optimize operations, therefore increase income, and therefore maximize appreciation. They don't have it. They don't even care sometimes because they're doing fine already. And so acquiring one of these RV parks or other assets owned by a mom and pop is incredibly powerful because it has tremendous latent, or in Buffett words, intrinsic value built in that you can extract by having a great operator in charge. And so that's what we're looking for in all those 3 asset types.
Got it. Now, what about location wise? Because in the summer, I'm in Michigan, being on one of the Great Lakes or being up north or being, at Mackinac Island, it's amazing. You can't drive a RV to Mackinac Island, of course, but you get my point. They're beautiful areas, but the winter, I'd imagine, it's very slow. You're not going to have a lot of RVs traveling around up north in like the thick snow. What locations do you like, and like where are you investing?
Yeah, this is very personal in the sense that I don't know what it would be like and what the economics would be of operating one in Michigan, because I just haven't been in that situation. But we've been investing in the Sun Belt, which would be, include Texas, Alabama, Georgia, etc. We've got one that is in Leesburg, Alabama, we've invested in. Who's ever heard of that? Well, I hadn't. But it's, 2 hours or less from Atlanta, from Little Rock, from Birmingham, and other major cities, Knoxville, etc. And so it's in a great location in the sense that people generally like to drive a few hours for their RV vacation. And so that's one of the things that is cool about this. And that is one of the great value adds of these RV parks. I named, 12 or 15 earlier, but here's a really big one. And that is, once you've got all those amenities in place, you've acquired the neighboring land. And that might be farmland or timberland you can buy for a fraction of what it might cost to buy commercial property in town. And you can expand, maybe double, triple, quadruple the size of the park around that central hub that you've already developed. That, my friends, is a big value add.
Wow, that's awesome. Yeah. And when you're going south is great too, because everybody up north during the winters, they want to take their RVs and head south. So that's a good spot to be. Now, have you gotten much into the commercial lending side of RV parks? Like, I'm wondering, what do the banks think of these things? And I ask that because when I'm looking at self-storage, they say, okay, great. Like, you have actual buildings here. There's value in these buildings. But if I say, well, I want to buy an RV park, or sorry, not an RV storage place, boat and RV storage facility, or I want to build a boat and RV storage facility, they're like, well, it's just land. Like, we're literally just financing land. And so if you want to finance land, they're like, fine, but interest rates will be higher. And we're only going to go 50% loan to value as opposed to, a lower interest rate and more like 75% loan to value with self-storage. So what do the banks think of this asset class?
So lenders caught on and began investing heavily, it's investing, but I mean lending heavily to mobile home parks, partly because Sam Zell led the way in that arena. And in self-storage, similar iconic people have led the way. But in RV parks, I don't think Sam has pulled that off yet. His company is still, of course, trying to do that. But I don't think that there is a great lending pool for RV parks. In fact, the operator we're investing with does all cash. And then he finds, once it's fully stabilized and all running at this new, completely different level, he then goes out and looks for, low LTV, perhaps in the 50% range, debt from a local or regional bank. But no, you're right. That's a big challenge. And that's creating another barrier to entry to keep small guys out and help the folks that hopefully we are investing in even, do better. And so investing for cash and then refinancing or financing later is a strategy that we're following.
Awesome. So if I understand correctly, you are more of a strategic partner, and you raise capital, but you're joint venturing with other operators who are in this space and to go purchase RV parks and then add value to them and get your investors a great return. Is that correct?
Yeah, that's right. We're picking these operators. We're putting them together in a hopefully diversified fund, and we're allowing them to perform and do what they do really well. And then we're passing those returns and hopefully profits along to our investors.
Awesome. I love it. I feel like you're ahead of the curve. I haven't talked to anybody about this asset class before, so it's very fascinating learning about it. Switching gears a little bit, can you tell me a little bit about the, I know you are passionate about the nonprofit that you guys invest in or you donate towards regarding fighting human trafficking. And I believe that's a big part of Wellings Capital. So I just want to learn a little bit more about it and what you guys do.
Sean, I was amazed to find out back in 2016 or so that if you took the record profits, and I don't know if this number is up to date to this year, but historically, the record profits of Apple, General Motors, Nike, and Starbucks, combined those record profits, doubled that number That's the approximate profits annually from human trafficking, according to the U.S. State Department. It's a massive problem. And of course, the hit movie of the summer, Sound of Freedom, is exploring that and hopefully bringing that to everybody's awareness. The problem for people like you and me who hear about this is we don't know what to do. What are we going to do? Go on a commando raid with that guy from the movie, into Peru or somewhere and try to free these children? Probably not. Am I going to send money off to an organization that I don't really know what they do with it? Probably don't want to do that either. So Wellings Capital, we've taken the same approach we have to commercial real estate investing. We are doing stringent due diligence on organizations to make sure that their values are aligned with ours and that they're spending their money well. And there's some charity navigator scores you can check to see, how well they're handling their finances. And so we're giving heavily to them. And so I would like to encourage listeners to consider watching the movie called Nefarious, which is from 2012. There's another brand new movie called Nefarious, but this is from 2012. And then also, of course, Sound of Freedom. And then checking out an organization we really love to support. It's called AIM. That's AIM. And that website is aimfree.org. Now, my company is actually doing an annual drive on Giving Tuesday in November. And we're asking friends and partners and other operators and investors to put up matching money and then have the public or have other people match that in this drive. And we've raised a total of almost $400,000 in the last several years. A lot of that came from one big event, I will say, 250 of it in one day. But we've raised a lot of money and we're trying to raise a whole lot more because, like I said, this is a big problem. And if anybody wants to help us with the matching, they can get hold of me. But, just as well, just give to aimfree.org.
That's incredible. That's awesome. Very, very cool. Yeah, it's it's really sickening because you look at, the other day I'm just watching a show. I think I was watching Jack Ryan with my wife and you get into human trafficking and I'm like, it's just insane to believe this is real, as I'm sitting here in, a nice neighborhood, a nice area, and that stuff's happening all over the world, all around us. And I think it's easy just to kind of ignore it, but it's very noble to actually go out and seek out opportunities to change it, to make an impact. I believe Tim Tebow, I think, has I think maybe it's his nonprofit. I heard Brandon Turner talking about that as well, regarding fighting human trafficking.
Right.
Well, that's very, very cool. I'm glad to hear you're doing that. So, I guess, where is Wellings Capital going now? Like, what are you going to be focused on going forward? And what's the best way for people to, get a hold of you?
Yeah, so we have also been investing in light industrial. We were shocked to find out that a lot of industrial parks, the kind along, I-94 or in Michigan, where you and I both have roots or have a background, those industrial parks, a lot of them, actually a huge percentage, are owned by mom and pop operators. So it's a great opportunity there. We also like tax abatement multifamily. Where the taxes can be abated for up to 99 years. And we're doing that right now. We're also investing in preferred equity. Did you know that Warren Buffett, in the fall of 2008, when the wheels were falling off the whole economy, he invested in Goldman Sachs when it was plummeting? He invested $5 billion in it. And he did it not through common equity, but he did it through pref equity or preferred equity. Preferred equity has some of the benefits and the downsides to both debt and equity. So like debt, it has a fixed payment stream. Of course, nothing's guaranteed. We need to, say that as a disclaimer, but it is a fixed payment stream just like debt. It's ahead of common equity in the capital stack, but it's behind debt. And it also has upside like equity. So a typical deal in pref equity these days in the 1 to 5 million range might look like an 8 or 9 or 10% cash flow stream, set up in advance, and then another 7 or 8% on top of that at refinance or the sale of the asset. So maybe a 15 to 18% total coupon or total annual return for a safer investment. That's a pretty good thing right now. And so if you can get access to pref equity deals, which are almost, I don't want to say impossible, but almost impossible as an individual investor, it's a great thing to put in your portfolio. And we are almost fully focused on that right now. So that's where we are with that. As far as how to get hold of me, you can reach me. You can get special reports on RV park investing, self-storage, mobile home parks, and much more at Wellings Capital. That's WELLINGS, wellingscapital.com/resources. And you can learn more there.
Awesome. Paul, as you're saying this, you reminded me of an equation that you put in your book. And that was, so if you took $1 a day and you doubled it, right? Like, I think it was, right? You doubled it every day.
You double it every day for 30 days. Yeah.
You'd have $1.4 million or $1,040,000.
Right.
But if you applied a tax percentage, right, of 40% to it, then you'd end up with, I think, $40,000.
Yeah. Isn't that crazy?
Amazing.
Yes.
Yeah. It's, but that speaks to the power of real estate in general, and getting in and taking advantage of depreciation and working with great operators such as yourself. So I just wanted to point that out. I thought that was a very, very interesting stat in there.
Yeah. Thanks, Sean.
But it's been a pleasure having you on, and I appreciate you taking the time and to explain the RV parks to us, and about the human trafficking, what you guys are doing in that space. And hopefully, I'll have you on again soon. It's been good to connect with another self-storage guy from Michigan.
That's fantastic. Sean, it's been a real honor.
Thank you. Thanks for joining us and being a part of the conversation with Paul Moore. We've gathered all the show links and we've put them in the notes below, so be sure to check them out. If you found any value in the conversation, please help us by spreading the word, sharing it with somebody, sharing the podcast episode, and also hitting that subscribe button. The subscribe button helps us tremendously. It helps us grow the show, helps us connect with more investors who are looking to get into real estate and achieve their dreams as well.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.